Hello, hello, hello. I'm a little early today, but I learned after the fiasco of yesterday's trying to go live precisely at 12:30 that I should leave myself a minute, minute and a half of change just in case I run into an error like I did yesterday. I ran into a unable to broadcast you error. It was horrible. I had to panic. Well, I never panic. You see, I sweat a lot, but I'm not sweating right now. But I didn't panic. I pivoted. Hey, Les. I pivoted, went right to the phone, and worked it from there. But I've now learned my lesson. I'm going to start minute, minute and a half early, wait till 12:30, and then drop the knowledge. But no more waiting till 12:30 and pushing the button, because yesterday proved that you can't trust technology. I've always been saying that, but now it's proven to me. I have data, and I'm sharing that with you guys. So we're running up on 12:30. I'm going to start right now. This is Charles Tank Harris, CEO and founder of Wealth Our Way. Always here to bring you 5 minutes of finance on your lunch break or wherever you happen to be. Just trying to educate all of my people in my community as to the various aspects of financial planning, financial advisory, work, the different things that are available to you on our platform that promotes financial literacy. Today we are talking about dollar cost averaging. I get a lot of questions from people as to what dollar cost averaging is and why I think it's a good idea. So the textbook definition of dollar cost averaging is investing a set amount of money at a set time interval. What's up, Brother Allen? Set amount of money, set time interval. You do this regardless of what's happening in the market. So the good news about dollar cost averaging is the majority of us are doing it even if we don't know we are, because all retirement plans that take a set amount from your check every pay period and invest it into a portfolio that's been chosen by you, that's a form of dollar cost averaging. The 4% that comes out your check twice a month, that set amount of money is going into the mutual funds that you have selected, and you are buying the market, so to speak, at up and down intervals. So let's talk about why you would want a dollar cost average. What's the advantage to it? So the number one thing that I find for advising my clients that they benefit from dollar cost averaging is it takes a lot of the emotion out of investing. You don't have to worry about what's happening in the market. You have a set plan. You're putting a set dollar amount in. Market up, market down, doesn't matter to you. When the market's down, it's on sale. You're buying more of it. When the market is up, it's pricey. You're buying less of it. And if you understand the golden rule of investment, it's buy low, sell high. So you would want more at a lower price and less at a higher price. Dollar cost averaging forces that to happen. Another advantage is it limits bad timing. So we think back to earlier this year, I want to say it was like March 20 something, where the market precipitously dropped and continued for a few days to go down. I think it hit down 30% over a week-long period. Imagine being the person who retired, had $1 million, decided to put it in their portfolio on that day, and lost 30% of it. Now, by the grace of God, it has come back. However, a couple things. If you needed your money to live off of, I use the example of someone retiring, they would have had to take some of the money that was already down out of their portfolio. That money would never have a chance to come back. So dollar cost average would avoid that. You put the lump sum in to a money market account, you take a piece of it every month and put it into the stock market or bond market as you see fit. That allows you to gain interest on what's sitting in the money market account, even though in this environment the interest rates aren't that great, but you're guaranteed not to lose in that environment. And then what's going in is buying proportionately as the market goes up and down. So before I bounce, I have to address what some people will say is the negative to dollar cost averaging. Some people believe that since the market always goes up over time, and by always, they're looking at the historical return, and we can never base the future on anything that's happened historically. We can use it as a reference point, but it's no guarantee moving forward. But people look at it and say it always goes up over time. So why wouldn't I want to put all my money in today and over time, 20, 25, 30 years from now, know that it's going to be higher? Why would I have wanted to average into a market that's going up? Goes back to what I said about the emotions. we had a decade in investments. And unfortunately for me, or I should say fortunate, because I learned some things, I started as an investment advisor back in 1997, November of 97, with a firm called Smith Barney. We had what was called the lost decade of investing from 1999 to 2009. Basically, it was a 10-year period that the market made absolutely no money. It actually returned a cumulative negative 2%. If you didn't have a dollar cost averaging strategy and you put all your money in beginning of 1999, by the end of 2009, you had less money. Most people made the error of pulling the money out during the bad times. Had you had a dollar cost averaging strategy, you wouldn't have been as affected by it. In fact, after the lost decade, people who dollar cost average, they made a slight return. So instead of negative 2, if they were averaging it on a monthly basis, they actually made 2.1%. Doesn't sound like a lot, but it's better than losing. Anyway, I promised you 5 minutes, you got a little more. Please visit us at www.wealthourway.com to learn more about financial literacy, learn more about how you can better yourself and your community financially. I will keep coming on every lunch day, 12:30. We'll expand from 5 to 15 minutes eventually. I'll keep coming if you keep coming. Have a great day.